Good morning. It is Thursday, 9 a.m. We're trading just under 39,700, and today I'm going to be talking a little bit about this book that I bought a couple days ago by Eric from Bloomberg. You've been following him on the ETF. I have. Anyways, he wrote this book a couple years ago, which I'm going to talk a little bit about. It's about the financial industry and specifically the fund industry and how it was really revolutionized by Vanguard and John Bogle and kind of what that means. So let me summarize this book in a few sentences. Vanguard it was started in the 70s by a 45-year-old named John Bogle, and it really took a couple decades to get going. It was really the first index fund in the world. It was the first idea where you could put money in and buy the entire S&P 500 index in one shot. It was not an ETF at that point. It was an index fund. Vanguard now does have ETFs, but the founder, Bogle, really sold this idea with a very simple argument. The argument was, trading fees are bad, right? You do not want to be trading a lot. You want to have the lowest possible fees. And his idea was, I'm not going to make money. I'm going to give back the fees. So just, we're going to manage these assets for the lowest possible fee structure. And what we want you to do is simply buy it and hold it forever. That was the idea. So this thing really ended up working in the 2 decades from 2000 to today, right? And it's worked so well that Vanguard now manages, about a third of every new money coming in is going to Vanguard. 1/3 of all cash is going to Vanguard. So it's just a giant in that respect, and it's all passive. It's all just indexed. They do have a few active funds. That's news to me. I did not know that they did. But for the most part, it's that strategy. And that sales pitch is what sold boomers on Vanguard. Now, let's take a little bit of a look to why that really worked. And, is this some kind of new technology that, that he found the Holy Grail, or did he just get lucky? So I want to dive in a little bit, and I want to work at why that really worked. Well, the reason it really worked is if you start going back to 2000, right? We have the S&P around 1,300, 1,400 right before the crash of 2000. Got down to about 1,000, right? But it has basically over the last 2 decades. It has gone up from 1,280 to almost 5,000, right? So it's gone up somewhere between 4 and 5x in 20 years. Now, that has not been lost on my generation, right? So this is really the big trend for Americans that everybody's talking about is this S&P, right? And so what does that work to? That works out to about 7% compounded per year. Now, if somebody says 7% compounded, that sounds fantastic, except if you said, well, you really have 5% inflation, which is kind of my real read of where inflation is, not for the absolute working class, but for the middle class America. Middle class America or upper middle class America, your inflation is going to be around 5%. The things that you want to buy are going to go up by about 5%. And so if somebody said, hey, I'm going to give you 2% a year, that sounds a lot less interesting. And, so I think that part of this is this money illusion, right? That people were willing to take the risk of jumping into equities, which were perceived as kind of risky. If you go back to the 80s and 90s, they were perceived as risky. It wasn't something that everybody would have in their portfolio. But, over the last 2 decades, this has been viewed as the normal thing to do, is to put your portfolio mainly in equities, right? And the government is really has a lot to do with this, because why did this phenomenon happen? Is it because the government, these companies were so profitable? No, it's really because we started printing really large amounts of money. So if you go back to 2000, right, we were at 55% of debt, our debt to GDP. Well, we basically more than doubled that in those last 2 decades, right? So when you double the total debt, right, that has an enormous impact, stimulative impact on all these earnings. So that is equivalent to almost all of the that explains almost all of the growth in the S&P 500. So if you take away that, again, it's this is what's accounting for the inflation. The rest is like a couple percent a year, and that's not something that a lot of people would get excited about. Now, this is the U.S., but every kind of economy and great civilization has their own timeline. And I want to talk a little bit about this timeline, which is the Nikkei, right? So the Nikkei had an amazing the 70s were bad in the U.S. Well, the 70s were fantastic for Japan, right? So if you look at from 1970, the Nikkei was at 2,000. Well, 20 years later, it was at 37,000, right? So the Nikkei has gone up 10x in 20 years, so even more than the U.S., right? So, and the Japanese weren't indexing, but they were stock crazy, right? Over the 70s, the 80s in particular. The 80s was just this absolute speculative orgy that was happening in Japan, and I was often in Japan in the 80s, and I can tell you that it was absolutely sheer insanity. So, if you got into indexing in 1990, right when it was starting to take off in the U.S., and you applied that same philosophy in Japan, you would have had nothing but pain, right? Because we still are not at the same level. 30 years later, we're still not at the same level that the Nikkei was in 1990. And again, I was there the exact day that it hit this 38,700 thing. I was on the floor of the Nomura Stock Exchange in Tokyo. And I remember the day when it peaked. And I remember after that, it just kept on going down and down and down. So we have these massive movements, and, we have these massive movements, and if you get on board one of these massive movements, whether it's the S&P 500 in the last 2 decades, whether it was the Nikkei from 1970 to 1990, whether it was tech stocks from 2010 to 2020, you get on board one of these decades or multi-decade long trends, and you just do nothing and you hold, you will make a lot of money, right? So it really doesn't have anything to do with indexing or anything. It just really has to do with jumping on a trend and staying there. Now, you can think about Bitcoin, and Bogle hated Bitcoin, and Vanguard hates Bitcoin, and I understand it, because this is part of their DNA. Their sort of culture is U.S. stocks good. You want to invest in money earning interest in U.S. stocks. I get that. But in a bear market, this book makes a very good point that the whole thing sort of falls in reverse in the bear market. So in a bull market, as the assets grow, the Vanguards and the BlackRocks and the Fidelities of the world, they just make more money. They have these tailwinds. They just make more and more and more money because they're getting a constant fee off of an asset base that's growing, doubling, tripling, quadrupling, just because of the market, right? So in a bear market, the exact opposite happens, right? And so there is a very real possibility that we are going to see a shift from the U.S. asset class, U.S. stocks, to something else. Now, if you look at millennials, they will tell you that that is Bitcoin. And why is it Bitcoin? Because Bitcoin is a very, very simple idea that can resonate very easily with this new millennial investing class. The idea is stocks and bonds and real estate are very expensive. They're trading at a 26 PE. That's expensive. Really, they're only yielding you 2% after inflation. So that's not really that good. And Bitcoin is just getting going. Bitcoin is new. Bitcoin is finite, so it will protect you against inflation. So you can take it with you. You can live anywhere you want on your Bitcoin. This is a very powerful, simple idea. Just like the idea of low-cost fees will track the market was a simple, great idea. So I think, and I rephrased this in one of my posts as an idea virus, and I really think that's what it is. It's a very great idea that over the next decade is probably going to translate into something pretty fantastic. Now, let's go back to where we are today. Let's go back to where we are today, and let's just look at where Bitcoin is. And I would argue we've got a bunch of different. We got some work to do to get it to where it is. Because if I look at this chart, it is not like the Nikkei chart of the 70s to 90s. It is not like the S&P chart. This chart is kind of a mess, right? Yeah, Bitcoin is up, from 1,300 to 36. That's great. It's up 3x. But this pattern here is not a trend that everybody's just going to jump on board. So what do we need? We need to see this thing sort of move up, up, up. It's going to take probably 5 years, and it's going to take a movement up to several 100,000 to potentially 1 million or more for everybody to really jump on the trend, right? So I don't think that this thing is at the point right now where those people looking at the S&P 500, these guys are saying, yeah, I don't need Bitcoin. Look, I'm on this exponential trend to the moon here. I can beat inflation. I don't need your big. I might take a little bit just in case it takes off, but I don't really, really need it, right? So that's where we're going. Once we get back out in, kind of clear this kind of area here, I think that's really when this thing becomes attractive to Wall Street. So I've been rambling a little long. I'm going to hop, but that's where we are. We're at 39.6. I will just say one thing. I think that the GBT selling is slowing down. Eric from Bloomberg has mentioned also that the regular inflows are also slowing, which makes sense. I don't think they're going to continue this way forever. And again, I would like you guys to buy this book. I'm actually going to be, if you catch this, I'm going to be in LA at Bloomberg's office watching Eric give the presentation on Bitcoin ETFs. I think it's going to be fun. It's at 3 p.m. today in Century City. So if you want to kind of meet me there, great, or afterwards. Love talking about Bitcoin and ETFs, but that's it, and we'll catch you next episode.